I want to introduce Dan Wilson. He is with Viking Mergers. He is partners with Dave Bogart. Um, Dave and Dan have participated. They are business brokers. They've participated in several of our deals with a number of our AEs. Some have made it over the goal line, some not quite. But I invited them to come and kind of talk to us from the sort of the broker side of the desk. Everyone else that's here on the call is in the buyer journey. Dan, they're taking part of our training at Acquira. They're relying on some of our team of associates for various levels of support and various topical issues, as you may know. And I just thought it'd be good to have a kind of an open mic discussion. If you've got a little bit of an opening statement or any kind of a stream thought that you'd like to share first, you're welcome to do that. But otherwise, we'll open it up to some thoughts and questions. So
yeah, I'll throw a couple things out there since so to understand my audience here are future buyers of businesses.
Correct.
Okay. I will say the most important thing, and write this down, it is by far the most important thing for you to realize when you are talking to a seller or another M&A advisor like ourselves, right, that you are keeping in focus that you want to present that what you are doing and buying the company is creating a safe place for their employees to land. That's one of the number one concerns of sellers is what's going to happen to my employees afterwards. Most of these people are, at least the businesses that we're selling a lot, are founder owned. It's their legacy. It's in some cases, it's their children that they didn't have. So it's very important to them when they exit that that there's a safe place for the employees to be. So with that, I'll open up to questions and give you guys anything and everything you guys need to know to position your LOIs in a better light against others that may be there. And
so I've got a couple I'll lead off with, if I may, Dan. One of the things that is kind of infamously associated with listed businesses, the perception is that sellers often come to the game with an inappropriate expectation of what the value of their business is. So talk to us a little bit about your role as a broker and advisor to kind of level them into the market and get them into the right band of eligible consideration for what they should be expecting as opposed to what they dream and hope for.
Okay. Well, there's going to be some generalized statements here because I don't want to put every Main Street broker in the same boat, but I've definitely seen a lot of them. First off, understand the brokerage firm or M&A advisory firm that is representing the business. If you're going to be dealing with Viking, you can be rest assured that the seller has an appropriate expectation of what offer should be coming in at. We're not taking anything to market where that's overinflated, or for instance, we do evaluation with a seller. We tell them their business is worth $2 million. They think their business is worth $4 million. We're not going to take it to market for $4 million. On the lower case, we're the Main Street brokers. So these are Transworld, VR, Murphy, Sunbelt, First Choice. A lot of these firms are franchise brokers. They're single shingle people for the most part, not always. They are they're gaming what they can to get a listing, to take it to market, and a lot of times those prices are a little overinflated. So do some research on who's representing them, and with us, you're going to have a conversation with us several conversations before you ever get introduced to the seller. So by the time you you meet the seller, you're already aware of what the expectations of where the price are. If we don't actually have the price already listed on the website, sometimes we go to market at market price. Those are for some bigger deals. But yeah, it is very difficult to combat a seller whose price expectations are not properly aligned. And it's for you guys to get it properly aligned. Come with all your ducks in a line, and with industry standards and comparables and things of that nature to help your case on why you're offering, 1 million instead of 2 million.
So as a follow-up to that, Dan, how important is it for the prospective buyer to be like laser spot on with their proposed price, as opposed to maybe a ballpark price that's, subject to due diligence, yada, yada, yada?
Well, we don't like going under contract with a price tag that's going to move. Sellers don't necessarily like that. I mean, there's some movement in them because bigger companies, if there's a working capital peg that you're shooting for, that could increase or decrease. There are some deals we've done in the past where the buyers have put in that they're going to pay, like, for example, 3.7 times trailing 12 EBITDA. And so 3 months later, when we're getting ready to close, you do the EBITDA calculation, everyone agrees to it. What's 3.7 times that? And that's what you're paying at closing. We've had sellers increase their sale price a little bit before, and we've had sellers slightly decrease. That's not common, but it does happen. So you don't necessarily need to be laser focused. I think some of the important parts when you're putting together an offer is simplifying the deal and not complicating it. We educate our sellers that seller notes are a form of the seller showing their confidence in the company after they leave. And if they show that they don't want a seller note of any kind, it could give a red flag to a buyer. That there's a lack of confidence of the business maintaining what it needs to afterwards. We only really entertain earnouts whenever there's a premium being paid on the price. Now that doesn't mean you're overpaying for it, but I assume, as most of you have been educated and know in the process of evaluation of a company, there's a range of value, and we'll just take a simple example of 3 to 5 times cash flow as the example. Well, what makes that business 3x versus 5x? It's not just the financial capital that the business has done or is proving. It's also the human capital, the social capital, the structural capital, and the customer capital. Some of the things that fall into there is, do they have a good number 2? Do they have a good management team? How long are their employees tenured? Or do they have a big turnover in employees? With customers, is it customer concentration, lack of customer concentration, length of customer relationships? How long have they been around? The structural capital and all that, their processes, their technology, their documentation. If all of these things are checking boxes on the high end, that's where you can really start getting to the 5x or even a little bit more maybe. And when you're playing on that side of it, it's a little bit more palatable for the seller to have an earnout. But if that seller is not involved in the company afterwards, where he's the decision maker, having that earnout be surrounded about profit and EBITDA is something that we're never going to tell our seller to agree to that, because they have no control over the EBITDA once they're not the owner anymore.
Right.
Having those earnouts tied to revenue, or if they say that there's a big contract that they just signed that has to come come to light, right, for that earnout, or something along the lines of if they've got 200 customers, and you're concerned about 10 of them, that if those 10 convert over, then the earnouts paid, things like that are much more palatable.
Well, and to everybody on the call here, what Dan's talking about, of course, for those of you that have been with Acquira for a little while, he's talking about our intrinsic value calculator. That's that plus or minus on the multiple to boost it from the 3 to maybe the 5, if appropriate. For those of you that are newer to our training and our systems, there is a calculator in your training material that shows you this. We call it the intrinsic value calculator. It is a pretty comprehensive walkthrough of all those pluses and minuses that Dan was talking about. And while we're talking about that, I'll just remind everybody that there's really 2 passes on the IVC. You want to do it initially when you're trying to put your LOI together based on everything you do get with the broker and out of the SIM data that's available. You make that first pass so you can try to dial in your multiple bid accordingly. But then after you get through due diligence, you get your quality of earnings and your operational review done, you're going to want to make one more pass with that IVC to be sure that it is dialed in exactly based on what you've discovered. And that's typically the spot where there's a little need and want to go back and fine tune the terms and perhaps even the final settlement price. But to your point, Dan, I think we try to get people to dial that in as best they can. But the origin of my question was that delicate balance between trying to respond to a listed offering that you've just found and the intensity in the market. It's kind of like if you take too long to analyze, the deal could be gone. And how do you really balance that idea to try to get your hat in the ring without having it gobbled up by another bid?
Well, once you engage with the advisor, ask them point blank the question: are we on a clock here? What's the time frame for us to come to a conclusion on whether or not we want to put in an offer? Find out what their process is. With Viking, we have a process that of the 50 plus advisors that are across our 15 offices, we all follow pretty much the same process with a little bit of our own personalities put into them. But you're going to sign an NDA, you're going to get a blind profile, you're going to have a phone call or 2 with us, you're going to get access to the data room, all right, with the data that was provided to us for evaluation. We'll get on another call with you and go through a Q&A. And after that time, you'll have enough information that you'll be introduced to the seller. Once you're introduced to the seller, I'd say that's probably when you're on the clock of, if you want to put in an offer, put an offer, and if you need to talk with the advisor or the broker on, if you really want this company, and this is what you're thinking and all that, what needs to be altered with this to make this more appealing to the seller.
Yeah. Well, and I certainly respect and appreciate that process you're talking about, because the alternative is, back to some of these shops that have less process, they're just grabbing listings as best they can. They're going to convince you that your LOI needs to be in tomorrow, and because they're going to paint the picture of immediate urgency. It's a hot deal. It's not going to last long. Blah blah blah. And it is hard to fathom that a good seller with a strong company has that kind of immediacy to them. I mean, if they're committed to selling, they want to get it sold, but they want it done right.
Listen, in 28 years, Viking has sold close to 1,000 different businesses. We probably close 50 to 60 a year. The fastest we have ever had anything under contract was 2.5 weeks.
Okay.
If they're saying that this is going to go hot and all that, that's just car salesman talk. Yeah, if I put a managed service provider on the market, because that was my background, I ran one for 16 years. Yeah, it's not gonna stay on the market long. We're gonna spend the first 15 to 30 days getting buyers in, and we know there's gonna be a lot of them that are interested. So in cases like that, we're gonna ask for an IOI and not an LOI. So we can go through the IOIs with the sellers to see who's in the ballpark, price range wise and all that. Because with an IOI, you're just given an indication of interest, and this is what you're thinking about. But if you're out there and biz buy sell or something like that, and you're talking to a broker that's a single shingle or one of those that I named and all that, there are some really good ones out there. But in my experience, a lot of them are listing mogers and car salesmen and all that. Ignore this is going to go quick. You got to get your offer in quick. You know, if those, I'm not sure what target range you guys are looking for businesses as far as purchase price wise. Is there something that's too small or too big for you guys?
Yeah, we generally advocate on the low side, probably nothing less than 3 to 400,000 SDE, and you can take it on up there, but the higher you go, you start running into the ceiling on SBA 7A lending at 5 million purchase. So we're kind of in that band.
Okay, so the 1 to 5 million purchase price in that area.
No, we've seen purchase prices on up to max the SBA. We had one recently that was right at the high side,
which is 5 million.
Right at 5 million purchase price. Yeah.
So you guys are looking to purchase businesses between 1 and 5 million. I say 1 because if there's a $300,000 SDE, that should get it to $1 million. If not, it's 9,000. So
right.
Yeah.
So you're applying that multiples. So to get to the purchase price.
So the bigger that number is, I think the less you're going to be dealing with those that are trying to force you into it.
Yeah, hot to try.
Yeah.
We've occasionally had that discussion. The reason I asked that question, there is a notion of trying to do your diligence and try to dial in the offer price as close as reasonable that you, the buyer, are comfortable with, but that can make rational sense to the broker and the seller if there's not a posted price sitting there.
Yeah, most of our deals that are 5 million and under, I'd say 90% of them have a posted price. Right? Because if they're going to be an SBA 7A deal, we have at least 3 pre-screens done by our preferred SBA lenders.
Okay.
And I would also recommend that if you, I know you guys probably had some SBA vendors you guys deal with and all that, but if you're going to deal with Viking or somebody like us that have already done pre-screens, you can cut the time dramatically because that SBA lender has already seen all the financials prior to.
So to the audience here, that's a question you might add in your discussion with your broker. That first call you have is to ask whether or not they've pre-screened with an SBA lender partner. And if they have that available, that's a very good checkbox.
If they have it available, ask them for it. Ask them for the introduction to that SBA lender. It'll save you time, for sure. And if there's certain banks that you like to deal with, Live Oak Bank is one of the ones we deal with a lot. Mark Pompeo is, in my opinion, probably one of the best SBA 7A lenders in the country. If you get there and they say that they've pre-screened it with Live Oak, and you dealing with somebody else at Live Oak, get introduced to their person and get your person involved with that person.
Yeah. And yes, to your point, as many of our folks know, we do have a couple. Live Oak is one of them, and also First Internet Bank, Alan Peterson, we do a lot of work with.
Yeah, we use First Internet Bank also, and And Will Tinsley is who we use with First Internet.
Yeah. Yeah. So let me open it up. Anybody have questions for Dan you'd like to explore?
Dan, I got a quick question going back to your initial comment there about buy sellers looking to is really a safety net for their company. I had an interesting conversation with a broker a few weeks back that struck me as a bit of a red flag, and I'm kind of curious about your take on it. The broker is quite forthcoming that the seller really wasn't concerned about who he was selling the company to. He just basically wanted to sell it, was only concerned about a dollar figure. Really, there was no kind of sentimentality, it seemed like there. That to me was a bit of a red flag, kind of the opposite of what you're saying. I mean, would you guys consider that? Would that be a red flag as far as if you're a buyer?
Yes.
Okay.
It would be. I mean, to make it simple, to expand on that a little bit, 99 out of 100 sellers that I have dealt with have their concern for their employees and the continuation of their businesses was just as important than the amount of money they were going to get to retire on or walk away. Okay. So if there's somebody that doesn't care about the other, that's something I would do diligence in pretty hard. Good question.
Okay. Anybody else?
And this is Adam. You mentioned earlier that once you have a conversation with the owner and you're interested in it, you should put in an offer. In today's climate, how much time typically would an owner put in with a strong prospective buyer? I mean, based on my recent experience, I had an opportunity where I was very forthcoming with the broker about my interest in the business. And I worked through what I think was a very poor broker that didn't give me adequate follow-up to reconnect with the owner. So assuming moving forward, once I get introduced to the owner and followed up, how much time should I expect before I put in a quality offer?
Well, I can't really put a quantitative number on that, Adam. That is a good question. With us, if I were to introduce you to a seller, after the conversation is over, I'm going to call you and have a one-on-one conversation with you to get your take on it. I'm going to talk to the seller and get their take on it and what they felt. And depending on what is said by both parties and all that, most of the time we're like, hey, let's get another call. There's some deeper questions that the buyer wants to get into and deeper understanding. Because one of my goals, and this is across Viking, by the time you go under LOI with a business, we want the rapport between the buyer and seller to be as good as it possibly can be, because we train our sellers, all right, to go into, once they go under LOI, to understand that they're not being questioned because they're doing something right or wrong. They're being questioned so the other person can learn. And it's time to build a partnership, even if that partnership is only going to be 30 days or 3 months or 6 months or 12 months. Right? You don't want that time to be agonizing for you. So build a partnership with them. If that means it takes a couple calls for you to get that good feeling in your stomach, all right, to entertain an offer from them, then if it takes a couple calls, it takes a couple calls. And but that's how we approach it.
Fantastic. I wish everyone did.
Yeah, I wish. Well, I kind of wish everyone did, but it gives us a leg up on some things for sure.
Definitely. Thanks, Dan.
So Dan, if I could pry a little bit, and if you'd rather not answer, I respect the anonymity about it. But in the idea of meeting a seller for the first time, for you, not a buyer, but just you, the broker, and if they start presenting you with company financials that are not going to pass any kind of sniff test, I mean, in terms of things like, it's not uncommon with sole proprietor LLCs that they pad a lot of stuff. They run a lot of stuff through the books for tax purposes. personal and otherwise, and it muddies the water on the viability of the business. And in worst case scenario, it makes it almost unbankable with the SBA. What kind of advice do you give those guys if you sort of see a trail of that in the financials they're giving you?
If they're not itching to sell right now, we'll work with them to get their books cleaned up and, basically, groom the business for a successful sale. We probably only take on 1 out of every 6 opportunities that we see. We successfully close well over 80% of the deals that we put on the market, and that number climbs the smaller the deal is. The bigger the deal is, the lower that number gets, because there's too many things that are out of our control when you're dealing with the 10, 20, 30, $50 million deals that we do. But in the space you guys are playing in, if they're too small or too bumpy, or they're on a negative decline or things like that, to be honest, I refer them down to the franchise brokers. I have one in Raleigh that I think does a great job. If you're looking in the Raleigh area, his name is Neil Isaac with VR Business Brokers. Up in the Richmond, Virginia area, Mike Metzger with Murphy is the only person we refer things to. There's a VR guy in Richmond that we're okay with also. So we'll refer things down to them that are too small or just not where we want to be. If we can't get pre-screens and can't get banks behind the deal, it doesn't go to market with us. It just doesn't.
Yeah, that's good. We have had a few occasions. They're minimal, and it's even hard to put a percentile on it because they're so minimal. But we have had deals that have ended up showing up as ultimately unbankable because of the way the financials lay out.
Yeah. Now, we've had deals become unbankable because of revenue drops, while we're on the market.
Yeah.
That, stuff happens sometimes, and it is what it is. I mean, we've definitely got some horror stories from deals that we've had over the years, from sellers completely ghosting us a week before closing to, buyers, having a stroke a week before closing. I mean, there's all sorts of things that go on.
Sure. Well, at the end of the day, it's a people game, so stuff happens to us.
Yeah, and that's the key thing that you just said there, and it goes back to the thing I started with. Making a connection with the seller is more important, all right, than even a lot of times the brokers you're dealing with. It's more important than the connection you make with the brokers, because if the seller really likes you, he's going to push that broker. He's going to push him to do his job or push him out of the way.
Got it. Yeah. All right. Any other questions, folks? Ideas, thoughts, concerns?
Yeah, just one for me, Doug. Hi, Dan. Mark Fields. Could you give a little color to the role of the broker post LOI? As Doug just said, it's a people game, so there's a lot of players involved. You've got, the broker wants to get to close to get paid that's fair. The seller wants to drop the business in someone in the hands that cares, and the buyer wants it. But there's a lot of back and forth. What is your involvement in managing those two orbs, the seller emotion, the buyer hesitance? Like, what do you typically do in that space?
We from the time we go under contract, we are playing everything from financial guru to data room guru to psychiatrist for both sides. I've been on the sell side and buy side myself when I own my own business, and I know the emotions that both sides go through. So we're explaining things to the seller. We tell our sellers up front, and before we ever go to market, that, hey, listen, when we go under contract with somebody, right? It will be a time after it goes under contract, before it closes, before something goes sideways. There's going to be something that was misunderstood or changed or something like that that's going to piss the buyer off or piss you off. And we get their permission at that time. And we even do this in our kickoff meetings, that at that time, we all need to put on our big boy pants and panties and all that and work through this, especially if it's something minor. But even if it's something major, have those tough, crucial conversations to get through it. So we're doing things like that on a daily basis through it. We're coordinating with both sides of the attorneys. We're coordinating with the bank. We're running a data room for all those sides to do it, making sure that all the documents are done, completed, done right. That when the draft of the purchase agreement comes in, we're reading it, and if we have questions, we're talking to the attorneys about it and to getting clarifying questions and all that, so that way we can intelligently speak to it with the seller. We're not going to do that so much with the buyer. We're going to ask questions on why this is like that, because in our world with Viking, our fiduciary responsibility is with the seller. We'll guide the buyer through the process, but we'll be a lot more intimate with the seller. If we need to get tough with the buyer, we will. I mean, one thing I hate is when I text or email a buyer and ask for a question and I don't hear anything for over a day. That pisses me off. And because time kills deals. Say that over and over and over. Time kills deals. So the quicker things can be handled, the better off you are. Mark, I think you said that was your name. I hope that answers your question.
It does. Thank you.
So Dan, I'd like to shift gears a little bit. I feel like I can't let you out of here without asking these two questions. One is our favorite topic, working capital, and the other is work in progress.
All right, working capital, the biggest deal killer in the world. We have changed our approach over the last 3 years on working capital when we do valuations, and we are telling our sellers and explaining to them in two different ways. One, that when we're doing your valuation, the comps and the industry standards and everything that we're looking at to get the multiples, the working capital is already baked into that number. So when we're presenting a valuation, we show them, here's your purchase price, minus our commission, minus your legal fees, add your cash, add your accounts receivable for work already completed, subtract your liabilities, and then subtract a working capital estimate. And of course, there's asterisks on that, so we can explain, depending on who the buyer is, there may be a working capital request. This is what your working capital is. We explain it to them on what working capital is. And I said, if you have a buyer who's getting an SBA loan, there's more probability that the loan's going to include the working capital, and you're not going to have to leave that money behind. We explained to them that money that's left behind for working capital is typically in the AR. The other way we let them know about AR is we try to put the buyer shoes on them and explain it as simple as, when you go buy a car from somebody, you want gas in it, right? You don't want it on empty. You don't want to have to go buy a car and then immediately run to the gas station and put your own money to fill it with a tank. And they understand that and they get that analogy. Before I go to WIP, is any questions or thoughts on that?
No, I like that summation, and I think that encapsulates a lot of the discussion that we've had from time to time about the working capital. And it's good to know that you as a broker are helping set that expectation, because we as a buyer community routinely run into sellers that don't understand anything about working capital.
Yeah.
They see 400,000 cash in their bank. They say, I want my purchase price and I want to draw that cash out at the same time. I want both. And could be possible depending on the rest of the term of the deal, but in most cases it's not. It's more of an either or, not a both and.
Yeah. That's the fault of the person representing them, not the fault of the seller. I mean, sellers should understand, business owners should understand what working capital is, but they don't usually. Especially with the sub $5 million companies. It's there's more that don't than do, for sure.
So given your sort of closing settlement calculation there that you described, and I took it that's kind of how you see that, how does that typically get translated into the purchase agreement and defined there? Is it just literal, a literal definition that's put in
there
there?
should be a literal definition of the calculation that you're going to do. What we would expect to see is current assets minus current liabilities in over a 3 or 6 or maybe a 12-month average of those, extracting out the cash account and the liabilities that aren't going to be there. All right, so you're basically running a balance sheet calculation on what the business would look like the day it closes, not what the businesses look like over the past 12 months. Because if there's liabilities there that are being paid off and that's part of the calculation, then it's a false calculation.
Right. Good point. Okay, so work in progress.
Yeah, so as far as WIP goes, what we're explaining to the sellers and how we look at WIP is the same way we look at true ups after closing. If you did the work, you get paid for the work. If you didn't do the work, you don't get paid for the work. And then same thing with you close in the middle of the month and the seller already paid for the rent. Then you owe the rent for half of the month, and the buyer owes the rent for the other half of the month, and it's the same thing. Whoever used the service has to pay for it. Whoever gained the profit, and with WIP, it's more about the profit because it's not necessarily the revenue, because you got to put the cogs into the WIP calculation. All right, to understand what part of the WIP is the sellers and what part is the buyers. We explained to them the bottom line is that you want your company to succeed. You want this buyer to succeed. All right, you're more than likely going to have a seller note. All right, you can't leave them empty-handed. So don't be Jerry Maguire walking out of the office grabbing the goldfish and everything else you can as you leave.
Yeah, I like that analogy. Good one. Anybody have questions about either one of those? Working capital or WIP?
I had a question about valuation.
Okay, Adam.
You mentioned, Dan, the concept of doing a multiple times TTM. I'm curious about how your valuation discussions with seller may vary between, let's say, company A, where they've got steady increasing revenue and profitability, versus company B, or maybe of 3 years, year 2 wasn't poor, year 3 is strong. Would you advise them differently from a valuation or a multiple perspective, assuming they're very similar companies?
Well, we do evaluation 3 different ways when we present it to the seller. One's a cash flow approach, which is how a bank looks at the business, taking that cash flow and subtracting out a debt ratio, a cost of living wage for the buyer, and the debt service, and to come up with what that value is going to be. The other 2 ways we do it is the comparables with other businesses, and then the industry standards using things like Business Reference Guide, Vertical IQ, Deal Stats, Peer Comps, and other what's the other, Pitch Book, and things like that we use. Businesses that you guys are typically looking for in the 5 million and under range, we're doing a weighted average of cash flow and EBITDA and revenue, and we're weighting each year with a different weight. And that's definitely an artistic part of evaluation and not the scientific part.
Sure.
We usually give the highest percentage to the last tax returned year. Businesses, banks look at businesses' tax returns, and that's all they give a crap about for the most part. You guys are looking at the real numbers also. So, what's really the cash flow number, because it's higher than what the tax return is.
Sure.
And almost always is. So, when we're looking at them, we're also educating them on the different types of buyers, whether it's an individual buyer or a strategic group or a private equity group. As an individual buyer, they're going to come in, they're going to look at they're going to want to see what has it done for me lately a little bit, but you're going to look at the weighted average over 3 years, because you're looking at long-term risk for sure, and you're going to have a bank that's going to need to get behind it. Where a private equity group is almost always more concerned and looking at the trailing 12, and a lot of times they're going to pay based on the trailing 12 and not what's occurred 3 years ago. Now that does differ depending on the different industries and types of businesses that are out there. All of them have different markers that they look at, but looking at a business and the value of a business in all those different ways, we do that with our sellers so they can understand that the range of value is we give them, listen, when we go to market, we're like, listen, your range of values, 3 to 4 million. When you're under 5 million, the range of value shouldn't be greater than that. It's usually a much smaller spread too. But different types of buyers are gonna zero in on the lower end. Other types of buyers are gonna zero in on the higher end. But when it comes down to it, your business is worth what someone's willing to pay you for it and what they can get a bank to loan them. That's what it comes down to.
Agreed. Thanks.
Yep.
Right. Good word there. All right, one more time. Any other thoughts or questions for Dan?
All right, good.
Okay, I think we got it then. Dan, thank you so much for sitting in. Give Dave and his daughter our regards. Hope that all pans out well, whatever it may be. And with that, I think we're going to let everybody go and give back a few minutes in the day. But thanks again, Dan, for sitting in. And if we can, we'll share your contact info with everybody. And I think a lot of people already have Dave's, but we'll get you included in the mix as well.
All right, great. Thank you very much.
All right, folks. Very good. Thanks, everybody. Good
You're
stuff.
welcome, Adam.
Thank you very much.
Bye-bye.
Thank you.